Hello and welcome to Switzer Investing TV. I'm Peter Switzer. Thanks for joining me. On a day when we're still worried about those Trump tariffs, the market was down pretty heavily in the morning, bit of a bounce back in the afternoon, and some particular stocks that we are here at Switzer have thought look really good value, have had a pretty good day on the market, and they include Macquarie in particular. And other ones like Goodman Group, they've also been supported, and I'm sure BHP has had a reasonable day after getting as low as $33. So let's talk to our experts about what's going on. But before then, I just want to make this point. This didn't have to happen. As Professor Jeremy Siegel of the Wharton School of Business at the University of Pennsylvania said of this is the worst policy mistake in 95 years. Donald Trump had a reasonable argument to look at the tariffs that other companies put on American goods, but the numbers he came up with were from cloud cuckoo land. Economists are saying it. Any sensible mathematician is explaining it as being ridiculous mathematics. The guys who have been supporting Trump and his tariffs, they are absolute nincompoops when it comes to calculating the real protection that these other countries have been imposing on America. And I'm hoping that Trump has the brains to come out and at least say to the market, those numbers are not final. I am a negotiator. And those sort of comments will make the market think, okay, this was a bit of a deal play. Something very unusual for international politics. It works in the Big Apple and the companies that Donald Trump might twist arms with, but not with international economies. And I think he's learnt that. The market has shown him that. And if he doesn't back away from what we learnt last week on April 2, probably should have been on April 1, on April Fool's Day, because that's what this has turned out to be. It's been a massive joke. If he doesn't back away from it, we will go into a crash. And if we go into a crash on the stock market, what generally follows is a recession. And if we get a recession, people will lose jobs. And sure, interest rates will come down, but lots of people won't have those jobs to actually pay those lower interest rates. So this is really important that Donald Trump says something to reverse the problems he created with his ridiculous tariffs, ridiculously set too high tariffs. He knows it. The people who actually constructed it, I think they've got the lesson. It's been taught to them by the stock market that what they came up with was ridiculous. Let's hope good sense prevails this week. So without any further ado, let's go to Mike Gable. I really want to see what the charts are telling him about whether this is a buying opportunity for many of the great stocks that have really copped it. So it's Mike Gable of Fairmont Equities. Thanks for joining us, mate.
Thanks, Peter.
Well, we've been talking for quite some time about US stocks, particularly the markets. We always start with the index, and the S&P 500 has been following your script perfectly. You looked at it in the past and said, yep, it looks as though it's on the way up. Well, you got this one wrong. Didn't you understand? Didn't you understand Donald Trump or something?
Well, it eventually has to go down, doesn't it?
Yeah, but I don't think you ever planned Donald Trump was going to make your forecast and prognostications wrong for the first time in a long time.
Thanks for that introduction, Peter.
Well, we need it because I didn't think Trump could be this mad. And I say that with the deepest disrespect because this is like, whether you like his politics or his social policies, this is crazy economics. And this is where I am actually qualified to comment on economics. And this is crazy economics. And the chart in many ways shows us this, doesn't it?
Yeah, look, at the end of the day, if you try to think of things rationally, he's clearly come to everybody with a solution, which is the worst case scenario. That's what appears to be the case.
Shocked by it,
and the market's starting to digest what that means, and there's a lot of fear out there. But we know that the most likely course of action from here is there's some sort of middle ground that gets achieved. He gets to say his he's now winning again and created this great deal.
Let's hope you're right on this.
Yeah, and look, and unlike other, I guess, major market pullbacks. So if we're looking at COVID, we're looking at the GFC. Obviously, this one was created by this one man, and quite simply, we're one press conference away from, seeing the market recover with a very strong relief rally. So
no press conference, crash.
Oh, look, I think that the markets are, I think in the US we might just have another day down, 2 days down, and then we'll get some sort of relief rally at a minimum to bring us back to where we were about a week ago. So from there we can reassess. So I know that investors might be concerned, do I now sell? I think after the market's already pulled back the amount that it has, unless we're going into another COVID, I mean, even if we were going into another GFC, you get relief rallies along the way, and sentiment is so poor at the moment. Stocks are so oversold that you'll get some sort of bounce, and you'll get a better chance to reassess what you want to do with those stocks.
I guess the important thing to remember is crashes generally will create a recession. Don't think we got one with the we got a recession with COVID, didn't we? Well, Australia did, so US got two quarters. And so what we have to be really careful about is, does this potential crash create a recession? And that's what I think Trump will try to avoid. And let's hope he does it this week. So let's go to the charts and tell us what we're seeing.
Yeah, so if we just stick with the S&P 500, because obviously our market will
let's follow the leader.
Just follow it. Where are we going to get this bounce? Well, there's some very interesting levels to bear in mind. So what we have here is a weekly chart of the S&P 500 going all the way back to just before COVID. Now, this blue line is the 200-week moving average. What you've noticed is, barring a couple of occasions, the big pullbacks in the market have generally found support at that 200-week moving average. Obviously, with COVID, we did dip under. So if you sort of closed your eyes for a few weeks, back above that line, that was a bit of a different situation. And even with the GFC,
all the way here.
we could see that at the start of the GFC, it did find support at that level, and it gave investors a number of weeks to assess what to do after that bounce.
But this is when Lehman Brothers failed, and it was like too big to fail.
It went and it ended up going lower. So will we go quite a bit lower, quite a bit under this line? Remains to be seen. I don't think so, but I think at the very least, another 400 points lower, and we're bouncing off that line.
Territory.
So as we speak, Peter, the market's open here on a Monday. The US futures are down 3-4%. So they're getting very close to that line. So that's why I think we could either get a reversal tonight. So Monday in the US, maybe even on Tuesday, we see some sort of bounce. And then heading back towards the 200-day moving average. I don't have that on this chart, but the 200-day moving average is essentially where we were about a week ago. So I think that the way it'll play out is we get some sort of, we'll be seeing some sort of relief rally in the back end of this week. We'd be looking at a bounce back to where we were at the start of last week, and then we can reassess from there.
Okay. The problem for you and for me is that when we look at these charts, it's usually we're looking for a trend that actually is telling us, all that great rising is probably dissipating at the moment, and maybe it's going sideways, or maybe it's going to fall. But this is like something from left field, and bang, we just dropped because the tariffs seem extraordinarily too big for the market to digest and accept. Let's go to some individual companies that are really suffering. Now, this is a great company, and in many ways, the Macquarie drop looks like the drop on the S&P 500, because many of us think that Macquarie is reflected by what's going on in the US stock market.
Yeah, exactly. And so this is a weekly chart of Macquarie. I think this is one of those go-to stocks that you pick up on a big pullback. We're not seeing the same scale of selling that we saw at COVID, but I'm sure a lot of people, if you had your time again, you'd somehow scramble and find even more cash to put into Macquarie. And I think this is a similar situation. Maybe it's not worth $240 if you're a bit bearish on it, but it got to this sort of 160 level, which looks like a pretty key level, and not that far above its pre-COVID peak. So, we're going back 5 years now. It's given back a lot of gains there. So coming into the studio, Peter, it was fairly flat. It was actually, I saw a bit of green very briefly with Macquarie today. After, so it pretty much opened near 160 and has already bounced back. So again, if this bounces back to where we were at the start of last week, you're talking $200. So potentially you're looking at a sort of 15% to 20% rally in Macquarie just to get back to where it was last week, and then it's still $40 under its all-time high.
I hope you're right, mate. It's my biggest holding, and so therefore I've dropped it this week, but still it's a good quality company. Let's go to another extraordinary business, and lots of people have always kicked themselves not buying at these levels and these levels, and then even the level before. But now this is like in buy territory for people who really want to get into Pro Medicus. What do you think?
Yeah, look, it's this is a daily chart going back to 2023, and for us it was a great trade last year. I think we got in on the pullback. So this blue line is the 100-day moving average, and it looks like during the
it really hasn't threatened this stock until
until recently. So that's been a good gauge for the stock. Every time it dips to that 100-day moving average in a rising market, that's where I think the big money just comes back in and buys the dip. So it was one that we did pick up. I think we got out and back in, only to unfortunately get out again, because clearly it
but if you get in there, you still did well getting out there.
But it look, I think it's one of those stocks you just keep buying the consolidations until the trend is over. So the trend's over for now. But again, I think
too early to get in, do you think?
Depends on your time horizon. So if you're looking
I've got 1 year time to get in or not.
I'm not sure. I think
He's
it'll.
not sure,
I think
ladies
it'll
and
bounce.
gentlemen. This is my cable not being sure. I've never heard you say that before. But
look, I'll elaborate a bit more at the back end of this this segment why I think that's the case. But look, I think we'll get a bounce. Like the rest of the market, it's already well off the lows. It's quite a sharp move. Generally, I think what will happen is it'll rally back up. Again, it'll come close to this blue line, and then that'll be a decision time. We'll have to see what's happening out there with tariffs and what is the rest of the market doing. And then, if it can get back above that line, that's fine. But I think so short term, I think there's a trade, but I don't know if it's going to bounce and then come back and retest these levels.
Yeah, but there are traders in there who can't resist selling when they make a 20 or 30 bucks on a stock. Let's go to another quality company, Goodman Group, GMG. Once again, it's fantastic on the way up, and it's been clobbered. Is it time to get in, or once again, is your wait?
Again, I think there's two parts, sort of two answers here. I think shorter term, it's a buy. There's no sort of obvious levels for me to say, okay, well, it should reverse here. I can already see intraday today it's reversed. And I just think if the general market bounces, you'll see it put on, a few dollars or so pretty quickly. And then we just have to, again, assess what else is happening out there. But we could see that it is back towards this point here, which was its previous all-time high before we had the market pull back.
Yeah, and this is when interest rates started to rise and tech stocks got sold off. And then once they thought interest rates hit a bottom, off it took again. Let me throw in then. Interest rates are likely to come down again. That should be good for a lot of tech stocks that really have copped it, shouldn't it?
Yeah, I think so. I mean,
any guide.
Yeah, look, I think there's still people out there saying that interest rates are not going to go down now because Trump is going to cause inflation. But I think that whatever is doing, whatever's going on in that head of his, I think the end result is to get yields down. He wants the Reserve the Federal Reserve to lower
yields
rates.
are falling.
And they are, yeah. The 10-year yield is falling a lot.
Yeah,
so.
yeah. Whatever's going on in his head, I think because of what we've seen, interest rates are likely to more likely to come down before they go up.
Yeah.
Okay, let's go to Xero, another great company, and once again, it's come off the boil. So what's the Xero story for you? Is it the buy or is it going to be a wait and see?
It's similar to PME. I mean, it hasn't, you know, there have been occasions where it has violated that 100-day moving average. But again, I think, you know, with a market going up and plenty of liquidity and interest rates coming down and low volatility, these tech stocks just every time they have a bit of a pullback, the funds buy more and that gives you the uptrend.
They are quality companies that form the basis of very good portfolios.
Yeah.
Let me ask this question. If Trump had not played a tariff game, do you think Xero would have been above its, that's
the 100-day.
Yeah, be above it right now?
Yeah, it only broke that 100-day moving average a couple of weeks before these announcements. So the whole market, of course, was already coming off and a bit concerned.
Yeah, February 14 was the start of we're spooked about tariffs, wasn't it?
And that's pretty much when it started falling. So if you'd come out with an announcement last week, which was fairly light,
could bounce off that.
Yeah, it would have been back up, but it's taken the other path.
At the moment, we haven't seen anything called Trump light. It's all Trump heavy. All right, so there's Xero. Let's go to your favourite. It's the first time you've ever come with a favourite, namely a commodity.
Yeah, look, I'm sure I would have mentioned gold
over
the past year
in the context of stocks.
Yeah. So this is a chart of gold going back to the late 60s, and what I've done is I've put it on a log scale, which means that, as you could see, that a movement, it's all in terms of percentages. So the movement from here to here, percentage-wise, is the same as that movement and that movement. And the reason why I've done that is to sort of highlight that despite gold being up about 50% in the past 12 months.
And at record highs.
And at record highs
ever?
up until, it was last Thursday, Friday.
Yeah.
I think it's still in the early stages of its current move. So when we were talking about gold previously, we're looking at sort of the breakout here, spent a few years trading sideways, and then it broke out. So each of these bars is 3 months.
Yeah.
And it broke out about 12 months ago and has rallied. But if we have a look at the longer term time frame, I think it's still in the early stages. So if we go back to the late 60s, there are a couple of occasions, sort of distinct periods where gold went up several times in value. So starting from the late 60s when the US removed, and the US removed the US dollar peg to gold, gold took off, from sort of, let's call it $30, $40 an ounce, and we could see that it ended up at around 650 before easing back. And then in the late 90s, early 2000s, we had the Asian financial crisis, the bursting of the tech bubble, and gold rallied from 290 to around 1500. So
clearly 82 to 2020 was a shocker for gold bugs, because people did nothing for 20 years.
Yeah, so it's definitely one of those things that you just don't hold forever, but there are distinct periods where it outperforms, and potentially we're entering a new one of these periods. So
a golden era.
So
I think Donald Trump's talked about a golden era.
Yeah, with what he's doing, even if he doesn't end up putting in these tariffs that, to the extent that he stated last week, he's clearly upending the world order to an extent. And gold, I guess we could say this is the sort of canary in the coal mine. It's already started rallying. It started rallying a year ago. I think it's still in the early phase of the move. So gold could be substantially higher from where it is now. And these other periods where gold rallied also marked a time when broader commodities rallied. So if we have a look at commodity stock valuations as a portion of the Dow Jones, they're at historically cheap levels. So in the early 2000s, you'll recall that all the heat came out of US tech, and that money found its way into vastly undervalued commodity stocks. So back then the Nasdaq dropped about 80%. I'm not saying it's going to do something similar.
That was the dot-com bust.
But if we assume that this era that we've had in the past 15 years of sort of low volatility, passive investing, just, buy the tech stocks on a dip and she'll be all right. If that's coming to an end now because of all this extra uncertainty, that money will flow somewhere. We've already seen it flow into gold in the past 12 months. And I'm not saying this will definitely happen, but I think for our viewers, I think the markets will bounce in the short term, as I said, but then let's just see what happens, because we may end up seeing a bit of a rotation more into some of our undervalued commodity stocks rather than all the money going back to the same extent into tech. And that'll be good for the Aussie market. Yeah. Just like in sort of early 2000s, the Aussie market outperformed the US market.
Yeah, and in a sense, if China decides to stick it to Trump by spending money and growing and demanding iron ore, it's going to be good for stocks like BHP, Rio, Fortescue, and all those as well.
Yeah, and look, they hold a lot of US Treasuries. I think I think China will continue to protect itself and other countries by further purchasing gold and other hard commodities than holding worthless US dollars.
Which are too strong, by the way, but the US dollars. Okay, so you were going to say something about, when I was asking you questions about these companies like Goodman Group and PME, you said there was something that you wanted to throw in at the end.
Yeah, so when I mentioned that with PME, I think it'll bounce strongly from here over the next couple of weeks. Yeah. But can it push on to all-time highs? I just think with this changing dynamic, potentially, money not necessarily flowing back into, it doesn't matter what Trump does in the next sort of week or two. I think that the market for a while will be skeptical that we're going back to the world that we were in for the past 10 or 15 years, where you just buy these tech stocks on every single dip. So PME will recover, but I just wonder if it'll get maybe close to where it was a few months ago, but then struggle as investors think, you know what, I'm going to maybe pull money out of a stock that trades on a P of 1 or 200 or whatever the ridiculous number is, and maybe pick up some gold and maybe some other hard commodities. So, this is gold in US dollars. There's a gold ETF called GOLD. We're holding that for clients. Otherwise, if you're looking for maybe a little bit more leveraged upside, there is an ETF with the stock code GDX. That's a VanEck Gold Miners ETF. And the interesting thing about this ETF is, despite the rise in gold over the past year, the number of units on issue hasn't gone up. So what that means is it's gone up in price, but investors aren't ploughing into it yet. So it'd be very interesting to see how this develops over the next few months.
And it captures a lot of gold miners.
A lot of the major international gold miners.
Okay. Yeah. Well, mate, thanks for joining us.
Thank you.
I hope you're right about the bounce, and I hope you're wrong about the need to go into gold. I want the old days to return for the stock market, but I do recognise that you could be onto the right observation about the future. Thanks for joining us.
Thank you.
It's Mike Gable, Fairmont Equities. And that was Mike Gable of Fairmont Equities. Now let's catch up with Adam Dawes of Shaw and Partners and see if he agrees with Michael in terms of some of the stocks and what other companies he might think looks like really good value at this point in time. Thanks for joining us, Adam.
It's great to be here, Peter. I wouldn't want to be anywhere else today, but it was talking to you.
You're an excitement machine, mate, and you've been in one of the most exciting and scarifying markets we've ever seen. Have you ever seen a market open up any lower than this before?
I don't think in my time, and I've only been broking for 15 years, and I've been in the industry for 22 years, but I don't think I've ever seen a market fall 6%, 500, 600 points on the open, and it was really scary. Not scary, it was enthralling to watch it. Yeah. But, the ramifications, are now starting to come through, and on clients' portfolios, there's a lot of nervous people out there, that's for sure.
Yeah, but of course the market has started to rebound. How convincing is the rebound?
Look, I think it is. I mean, look, there's always going to be people that are going to try and pick up a bargain, right? You know, BHP at $33, right? Like, you know, it hasn't been there for a while now. So, you know, people are picking up these bargains. And what has been really comforting over the last sort of month and a half of this market downturn, we haven't really seen a lot of buying come into this market to support it. I think today we definitely saw some buying coming in, and we saw, you know, a bit of support coming through. But as to what is to happen tonight, and, you know, I've been talking to clients about this is like an earthquake. You've got the first initial shock, and then you're going to have all these little mini aftershocks that are going to be coming through the market. And that's what we're going to potentially see over the next coming couple of weeks, these mini shocks as the market readjusts to these new levels.
I've been arguing that, you know, this has been a Trump-created correction. We're not at a crash yet, but if he doesn't say anything tonight, I suspect we'll go into crash mode, 20% down. Do you think it's pretty well likely?
Anything's likely at the moment as far as the amount of fear. Remember, fear and greed are the two emotions that run our market, and there is a lot of fear out there at the moment. I think Trump has intentionally done this, and it's more of an economic war than putting a war on, you know, with boots on the ground and trying to take over or protect or something like that. This is an economic war against many, many countries around the world. And it'll be interesting to see, and this is the aftershocks, what those reciprocal tariffs or those other effects that will come through onto this market. I think he has to say something to calm markets down, because he would have a lot of advisors in his ear going, you know, you've got to say something, you've got to be out, you've got to be on the front foot. But a lot of the time, I think this is sort of playing into the overall view that he wants to get a lot of fear in the market so that interest rates start to fall, and he then can start to unwind trillions and trillions of short-term debt into longer-term debt, which is going to help for tax cuts and all those kinds of things going forward. So he might say something. He has to calm markets down. But if he doesn't, I think we're still in for another tough ride in the US tonight.
Yeah. I must admit, I feel as though this is a lot of, oops, we made a mistake here. We better make it look good by saying we were trying to get interest rates down. You know, call me a cynic, call me an economist if you like, but I do think that's the case. And I think Professor Siegel from the Pennsylvania University, I think he got it right when he said this is the greatest policy mistake in 95 years. And probably the Smoot-Hawley tariffs were probably the one before that, probably was 95 years. And but I think the bottom line is this: our market is completely spooked, and I just suspect unless he's able to say, look, I am the game for negotiation, that would be enough, I think, for the market to think, okay, it means that, you know, the 67% tariff on China is negotiable. You know, even though it's 20 plus 34, but they reckon in real terms it's 67%. If he's prepared to say we can negotiate, I think the market said, okay, right, we've gone too far. We didn't think they're going to negotiate. Pete Navarro said no negotiation. Trump did say, I'm prepared to negotiate as long as the offer is phenomenal, but that's typical Trump. I think the market really needs something tonight. And if we don't see it tonight, I think they will sell off pretty hard as well.
Yeah, I agree. And you know, it's been, well, S&P's down 10%. You know, in the last 3 or 4 days or two, you know, a couple of trading sessions. So that's a big move for the US. Now, if you put that into perspective, that sort of brings us back to sort of January last year, not this year, but last year. So a year and a half, you know, a year and 3 months. So when you look at it, it's actually not too bad as far as the rise of the S&P or the Dow and whatnot. So that's what I've been trying to talk to clients about, is trying to put it all into perspective, that that, you know, we are in this, and obviously we're getting washed around with everything that's happening. But yeah, he definitely needs to calm markets down, and calming those markets will then allow people to now think about, okay, I'm going to step back in. And I reckon there's a lot of cash still out there, Peter. There's definitely a lot of cash ready to go.
Yeah. Well, remember, this really started around February 14, didn't it? February 14, 17 in America, where started getting spooked about what tariffs might mean. And I don't think they ever believed, the market believed, that it was going to be as bad as this. And I think that's why I hope he walks back a bit from it anyway. But let's talk about the stocks that you've been telling your clients look like really good value right now. So why don't you kick off with the one that you started the day with?
Yeah, well, bought some Macquarie for clients. That's been a fantastic one. That has intraday is actually higher than from where it started. So I think looking certainly not the banks, but looking at Macquarie as an investment is absolutely fantastic. I've been fairly vocal in around saying anything under $180, I'm comfortable to buy.
Yeah.
It's around that 160, 165. There could still be more downside to this. And what I've been saying to clients is, look, if you're wanting to put 50 grand into a stock, let's buy half now. Let's wait 3 or 4 days and let's buy the other half, right? We don't have to do this all at once. Let's be measured on this. Let's be understanding, because at the moment you shouldn't be selling, right?
Yeah.
Nobody should be selling. It's either hold or buy more, because the horse is already bolted. We've already we've had our lows. So for me, I think that calming clients down, Macquarie I think is a fantastic investment, and you can't do too wrong when it's around here. So that was one of my first stocks that we picked up this morning.
What was your second one?
Well, the second one was BHP. Peter, you got to stick with the quality, right?
Yep.
Stick with the quality, and you've got to do. And I'm staying away from the banks, being Combank and things like that. But BHP at $33. Look, I think it is a great business.
It's money for jam.
Correct. And with the dividend yield the way it is, I think it's looking around about 10s plus, Frank. Like, even if the dividend does get pulled back, which we potentially suspect it will, you're still going to get a really good dividend, and you're still going to get a fantastic quality business. So the second one was BHP.
Yeah. I was invited to a BHP dinner last Monday.
Right.
With the commercial officer, Ragnar Udd, his name was. But I sat beside the chief economist. And guess what? I talked about China all night, and he did not have a negative view on the outlook for China. And
Wow.
that's augurs well for BHP, I think, quite frankly. So I'm with you on that one. What's the next one?
So the next one was a little bit further afield, as far as some of those not speculative, but James Hardie. It has already been hit really, really hard, and it obviously has then continued to get hit. But I just think that overall, I think the market now has priced in all the bad news for that massive acquisition that they're going to do in the US.
Yep.
I think that's sort of all moved past it. And I thought James Hardie was looking really, really good here. We had a lot of clients wanting to sell as well. So there was a lot of sells that we put through. So that was their idea. That was not us, and we couldn't talk them off the ledge. But James Hardie was the third one. We have bought lots more, but I can't really remember them, Peter. So don't keep quizzing me on.
No. But I'm going to throw a few at you, because I've talked to Mike Gable earlier, and Paul Rico will be coming on the show later. I wondered whether this is the time to buy Pro Medicus. We missed it. You mightn't have, but I know I
did.
missed it.
No, I missed it. I missed it 100%. Yeah, 160 or something, whatever it is.
Yeah, 160. Yeah.
Yeah, I mean, you look at that from a long-term perspective. It got to 300. Yeah. Gee, that unwind went quickly, didn't it? From 300 down to 160. Yeah. I bet there's a lot of shareholders sitting there going, what the hell just happened? But you're right. I think I mean, does it take away its market darling status now? It doesn't have to reassure the market. I think there's a bit of that will need to happen. But gee, you pick them up 160, get rid of them at 220, 250. That's not a bad trade.
Yeah, that's right. And I think my view is that every expose on the company keeps saying that they've only got a small percentage of the US market, but their product is so distinctive. They don't really have rivals at this point in time, and they haven't really explored Europe. This seems to be a company that's got so much potential. And I guess if you took a 3-year view, 160 is going to be a very cheap entry price, I reckon. Okay, what about my darling stock, Xero? I always love Xero, and it's come down a lot. Is it a good entry price for Xero?
I'm steering, not steering clear. I am cautious on the tech stocks at the moment. You saw Live 360, you saw Zero, you saw these beautiful businesses that really, nothing's changed as from Friday or Thursday last week to now. Nothing has changed. I think that they've had such a good run, like Pro Medicus has had such a good run. I think there'll be a little bit more profit taking in those names. I still love them, and we've held them all the way through, and we'll continue to hold them. But I think, those tech stocks have had a good run, and so what you can see a lot in the market is obviously the gold stocks that got hit. Domain Group, it's doing an offer at $4.42, $4.43. It's now $4.11. What you're seeing is liquidity. People are looking for places where they've made some money to take that out to then pick up some of these other bargains, like the gold stocks, like those kinds of things. So that, and I think the tech stocks aren't immune to that need for taking some profits where you can to then reload the portfolio again. And I think that's why I'm just going to hold off on those for another week or so. We want to let the dust settle a bit. Nothing's changed, but I just think that there could be a little bit more selling in those names.
One last one. You mentioned gold, and Mike Gable likes gold generally as a commodity. Is there a gold company that you guys are favouring more than others? Like, we always love Northern Star, but really it has gone. Everyone's bought Northern Star. Is there a gold play that maybe has not had as much attention, but still has a lot of upside?
Yeah, so it's an interesting one. I've been doing a little bit of work on KCN, Kingsgate,
which is Kingsgate. Okay.
Yeah, so it's KCN. It's a producer, so it's not an explorer. It's in Thailand. It's had its warts. It's got some bubbles all the way through it, so you got to be a little bit careful. But on the production side, they've just expanded a couple of areas. KCN looks quite interesting as far as a gold play that's in production and is making some good cash at the moment. You don't want to be going for the explorers because they're going to continue to need money. The explorers can't, but those ones that are producing, and Evolution, if we stay in the stick with the quality, Evolution is something that I'll definitely continue to keep buying through this cycle.
All right, Adam, thanks for joining us. See you in a couple of weeks' time.
Thanks, great to be here.
And that was Adam Dawes, Offshore and Partners. Now let's catch up with my colleague, Paul Rickard of the Switzer Report, to see what he wants to throw into the mix as companies that really are worth thinking about, given the fact that Donald Trump has taken share prices down further than most of us were expecting. So without any further ado, let's catch up with Paul Rickard. So how scared are you about all this, Paul?
Look, I'm not scared, Pete. I think there's a lot of unknowns, and we're in an environment where, it's going to change from day to day depending on what sort of mood the president and his team are in. And he'll want to declare victories at some stage, but he'll need people to compromise and want to do a deal. And until that happens, the market's going to be pretty focused on the downside to this, which is, some people labeling it the most crazy economic policy in 100 years.
Yeah.
There's probably a bit in that, and that's why the markets have done what they've done.
Yeah. Yeah, I think probably the Smoot-Hawley tariffs sustained the Great Depression. It didn't cause the Great Depression, but if it didn't come along, I think that depression may well have been a little shorter.
And the other factor you've got to, the American consumer is so important to the American economy, more so they are in Australia. And so if you get a downward spiral in consumer confidence and consumers pull back, you'll see, notwithstanding any tariffs, that'll show up in terms of company profits. And I think that's what the market's sort of, in the last 24 hours, particularly with the retaliation by China, has said, okay, well, we've now got a significant chance of some sort of recession. And, the Fed's going to be a bit, coy in terms of lowering rates. Not saying they won't, but they're going to be worried about sort of the worst outcome, which is stagflation. Yeah. And in that environment, company profits suffer and share prices suffer.
Yep.
And that comes after a really strong share market. I mean, it's been a great run up.
It has been a great run up. It's only been spoiled by a man who thinks that tariffs are a great idea. And it's interesting, Paul, that you talk about the consumer. It's the US consumer who's largely created this tariff because they're the ones who buy foreign products. Foreign products are actually cheaper, and US consumers buy them.
Yeah, that's strange, isn't it? Yeah. Not like us in Australia. We always buy Australian made. But, no, of course, consumers are doesn't matter what they do.
rational.
They're rational, right?
Yeah.
The cheapest price, and not just, they're also good quality.
Yeah.
Let's
And by the
let's
way, they buy a lot of Mexican and Canadian products, which are owned by US companies making them in those countries. Anyway, let's not.
Yep.
We're dealing with Trumponomics 202. 101 we live with now.
Let's go 202.
202. And let's just hope he comes on screen somewhere out and says, you know, I'm up for negotiation. I think the market would like that. Let's go to just what you are buying now.
So a couple of companies I tried to buy today, I've bought a bit of. One's Goodman Group. That's actually almost closing up near where it started, where it finished on Friday. Macquarie's done really well today. That's another one. Now, it's been a really bad performance the last couple of weeks. Macquarie touched almost 240 less than a month ago. And on Friday, it closed at, I think, about $174, $175. It opened today at 160.
It's an $80 drop. Yeah.
There was almost, and it's gone up all day. It's now around.
Thank God. I hold a lot of that. I got to leave my portfolio.
So that's one. I like the look of Pro Medicus, but I'm a little scared because that's still a super expensive stock. And one of the things that happens in markets when you sort of get into, I won't say it's a bear market, but you get a serious correction, is markets do reprice, and it takes a while to recover. It's not just they go down and they go up again. You know, in a really strong market, you see it in the IPO market, people are prepared to pay big prices for great companies. Pro Medicus is a great company, but they're paying super price. And when you get a change in sentiment, I'm just not sure that, although it's a great business, the rebound may not be what you expect. So that's what I'm looking at. CAR Group's another one, Pete. That's come off from about $42 to just, I think, a dip below 30 today. They're probably the main ones.
What's your thinking of CAR Group? You know, you've been talking about it for some time, and obviously you didn't mind it around 40, but at 30 it seems very attractive. But what's the underlining thoughts about that company that gets you on?
Well, it shouldn't be, I don't think, affected too much by recession come tariffs. It's a very, most of its business is now outside Australia, in places like Brazil and in places like the American market, where doesn't compete in, traditional motor vehicles. It's really specializes on the SUV and the, those.
Do Americans like big SUVs?
Those RVs, I think they call them, right? That type of market, mainly secondhand. But so, look, I guess I'm not sure what the impact of Trumponomics is on CAR, but I don't think there's too much there. I guess it's somewhat still exposed to the consumer, but it's come down a long way and it's shown a good history of growth. That's one. I mentioned Macquarie, Pro Medicus, Goodman Group. I think Woodside looks interesting. Now, the oil price has been absolutely smashed the last couple of days. Woodside, tends to go, like Santos, they tend to go up and down with the oil price. There becomes a level, though, where just because of its long-term gas contracts and stuff, that it's much less vulnerable to the spot oil price and has quite good cash flows. Maybe puts off a development, reduces capital expenditure. I don't know. I just think that looks... that market's gone a bit too crazy there. BHP, maybe. I think you've got to be a believer that the commodity market's not going to suffer serious damage.
In fact, Gable actually thinks the commodity markets could be where the attention goes, and gold being a commodity clearly, but he is thinking that maybe you often see that stocks that are in favour, like tech, there can be a little bit of apprehension towards them. And therefore there's a look to say, well, what looks really underpriced, and commodities are.
I mean, this is where they love tech at these prices. Now everything else come off, and tech's held up. It got punished last week, but it's actually held up quite well today. It's interesting. What's finally caught up with the Australian market is banks. Now, banks have been absolutely smashed in the US and in Europe over the last 2 nights. And on Friday, we had the absurd situation where I think CBA ended up. Today it's off about 7%, and we've come to realise that if the scenario of a recession, global recession brought about by Donald comes true, and that's just a scenario. No one, it's just. But banks aren't going to be great. They're going to have from clients
Yeah.
with
Slower businesses,
business.
lower interest rates, all that sort of
Yeah.
stuff. Yeah.
So they've been hit pretty hard, and it's the Australian market tended to ignore that until today.
Well, you and I have been
I
opposed to
still
banks for
think
some
that
time.
sector is expensive, so that's not where I'm looking. Macquarie's a bit of an exception because it got punished so much the last couple of weeks.
But it's also a proxy for the US market. It makes a lot of money in the investment sector in the US, doesn't it? It makes a lot of money. And therefore, if America's doing well, it'll do well. And on the subject of banks locally, you and I have been opposed to them for some time. We need banks to fall to prove that we were right.
Well, it goes back to one of my arguments, Pete, about people say to me why I don't really think the Commonwealth Bank's got a lot of value at $155. And I say, well, okay, you're getting a 3.25% dividend yield, and it's got almost no earnings growth, so 1 or 2%. So fundamentally, you know, what's the attraction? You can stick your money in a term deposit from the same bank, government guaranteed, and get 4%. Okay, so zero risk. Whereas 155, you take risk. I sort of say, well, you're going to make an extra 2 or 3% and take the risk. The sums don't add up.
That's right.
So there's probably a bit of value in some of the others. I'm a huge Commonwealth Bank fan, as you know, right?
You're a huge Commonwealth Bank shareholder as well at very low prices, ladies and gentlemen.
But, you know, I just don't see it. I don't think in this environment where we are, maybe the game has changed because of what, and who knows? Like he'll come out tonight with some maybe announcement and the markets will go for a little bit of a rally and, you know, but the game does appear to have been changed, at least in the short term. And the recession stagflation is now serious probability, whereas, you know, a month ago it was
ruled out.
Exactly
right. That's Paul Rickard of the Switzer Report. If you want to know more about the Switzer Report, you're going to become a subscriber. That's Paul Rickard. Thank you.
Thanks, Peter.
And that was Paul Rickard of the Switzer Report. If you're not a subscriber to the Switzer Report, I recommend you become one, because it's not just the sort of information you get on this TV show. We have a lot of other really insightful analysts who come up with some really great ideas to build your wealth. Thanks for joining us. See you next week.